but let me just give you a very brief bio. Reverend Dr. Darren L. Page is currently serving as senior pastor at the Greater Highway Deliverance Temple in Utica, New York. He also served as a national finance administrator for the Greater Highway Deliverance Ministries under the leadership and of the presiding prelate Bishop Liston Sr. Pastor Page is also a member of the Beth Rapha Alliance under the leadership of the Honorable Reverend Dr. Jacqueline McCullough. Pastor Page currently is a career agent for the New York Life Insurance, where his office is located in White Plains, New York. It provides financial services to help people protect the ones they love, the things they own, and the finances that they acquire. Pastor Page was formerly the principal at the Highway Christian Academy, located in the heart of New York City, prior to his career change to New York Life. Pastor Page holds, to his credit, a bachelor's degree in business administration and accounting from Fairleigh Dickinson University, and a bachelor's and master's degree in religious education from United Apostolic Cathedral Bible Institute. Currently, Pastor Page holds to his credit a doctoral degree in Christian education at the Beth Rapha Bible Institute under the leadership of Dr. McCullough in Pomona, New York. He is married to Deborah Page, who works faithfully at his side in ministry. They have 3 lovely children and 2 wonderful grandchildren. One of the scriptures that motivates Pastor Page is Psalms 91, verse 1. He that dwelleth in the secret place of the Most High shall abide under the shadow of the Almighty. We're very happy to have Pastor Page. Put your hands together and receive him as he comes at this time.
Good afternoon, everybody. So glad to be here. We would like to first give honor to Pastor McCullough in her absence, and Reverend Pastor Robin, and to all of you that are in your respective place, those that I do know and some that I don't know. Just glad to see you. Also, my hats is off to those that are running the foundation, the Educational Foundation, the Phillips Foundation, which would be Reverend Katrina Huffman, Reverend Nadine and Brian McKenzie, Reverend Rufus and Sonia Pope, and Brother Damian Green, who's assisting me today. So let's just put our hands together for those that have put this wonderful event off today. And to the moderator that was speaking before me. So today we want to talk about life insurance. And New York Life, as we're getting the screen up, is a company that deals in insurance and financial services. It's a company that's been around for over 169 years. So it's a very solid company, a company that a lot of people depend on. And we've helped a lot of people. And how I got to New York Life, number one, was I was a principal of a school, as you heard Reverend Darnell say. One of the members of my church passed away. And it was a very trying time for the ministry, because you know that ministry is very costly. Things of that, come up. And when this person passed away, she did not have life insurance. So what it did, it caused a hardship, not only to her family, but to the church. And it was just very interesting to me, because it was very embarrassing. If something were to happen to you, it is very difficult for your church family, for the ones you love, and people of that nature to have to bear the burden of putting you in the ground, or however they dispose of your body. So it was through searching a new career after the school had closed and things had happened that the New York Life came to me. So it was a godsend. So I thank God for it. Working into my second year. So it's been a good journey. It's been a very busy journey, but it's a journey nonetheless. So we're ready. So this is my personal information in regards to how to get me. Those of you that will be given a card, I want you to get a form. You can give that out now. We have some forms that we want to give out to you. And then what will happen is, in the near future, if you decide to need more information, or you want to just hook up and find out what you may not know or what I may not be able to cover in this meeting, we will make that time available to you. Please fill out the information card. This helps me to at least assess myself and give myself a grade. And those of you that do give me your information, if I call you, please answer your phone. Please answer your phone. Just say hi to me. Do something, all right? So we're going to make it light. So you can take me to the next slide. Next slide. Now, the purpose of this slide is to talk about promises. We all make promises. One promise in particular would be if you were to get married. I heard the young lady talking about it earlier, about the first husband and the second husband and naming all those husbands. But basically, each time in each marriage, there was a promise made. And ultimately what happens, in order for there to be a second or a third, the promise had to be broken. So with promises that are made, we have promises to pay our mortgage or our rent if we rent. If you're married, you're starting a family, you promise to provide for them, to take care of them. Maybe you've promised to send your kids to college without saddling them with student loans, which she was talking about just a few minutes ago. So there are promises that we make in life. Promise to pass your business on to the next generation or provide an exit strategy. So we're constantly full of promises. Next slide. And in that, people have to depend on you. And how do you plan to keep these promises if something were to happen to you? A lot of times, people, when they're feeling good, they will make a whole lot of commitments. They will say a whole lot of things that they don't mean, or that they may mean, but they did not think it through. So basically what insurance does, insurance helps you to keep your promises, and it also helps you to stay on target in the event that something were to happen to you. And basically with insurance, whether it's life insurance, casualty insurance, auto insurance, whatever, you get insurance hoping for the best, but you're preparing for the worst. And a lot of times people don't prepare for the worst. And when the worst happens, they're caught off guard. Reverend Amy, it's good to see you today. All right, so basically what we're trying to do is get people on point where through these types of seminars and these kind of events that we're having, where we can put the people of God and the church world as a whole, make them whole, not just in the spiritual sense, but in your natural sense, so that your business is done correctly. While we're working on our soul insurance, we need to work on other types of insurance, okay? So how do we plan, next slide, how do we plan to make those promises? We think about, number one, achieving our financial promises. We usually think of two ways to get there. And the two ways that most people think to get to their financial promises would be savings and investing. And oftentimes these key ingredients are used to help us to achieve our goals. And often if something were to occur in any of those plans, we have no safety net. And basically, in planning, you've always got to have a plan A, B, C, and D. And I know a lot of people say, well, you know, I'm walking by faith, because I've met a lot of people in this walk that don't believe in insurance. You know, I'm trusting God and da-da-da-da-da. But God helps those that helps themselves. And a lot of times God has given us the tools and what we need in order to plan our lives. But what happens is people do not plan for the future. And sometimes it becomes very selfish, because when you leave it to someone else, you're really not caring for the people that you love. And with insurance, what it does, it protects what you earn, what you owe, what you own, and those that you love. And not only that, it also helps to leave a legacy for the people that you have left behind. And now the new thing that church people are doing, they're leaving legacies to their churches rather than just their families. So that's a whole nother piece. And it's very interesting, because I've been writing a lot of policies for church people. And with the underwriting department at New York Life, I said someone there must be atheist, because every church policy that I've written where the church is the beneficiary, they take it through hoops like you would not believe, because ultimately the enemy does not want us to have church. You all know that. So it's been an uphill journey, and basically we get them through because it's the law. You know, when you own a policy, you have the right to decide where your money goes. You have that right. So if anyone tells you not to give your money to the church or to your family or whatever, you as the policy owner, you have that right to determine where your funds could get funneled, where your funds will get funneled. And what happens is a lot of times we've noticed that people don't have living wills and they don't have accountants. And oftentimes the accountant that has the greasy spoon is not the accountant that you really want, but you want someone that is skilled at what they do. For example, we have a skilled pastor here. So we come every time we get a message, we're fed and we're walking out of here fat spiritually because she's skilled at what she does. So you need people in your arsenal that are skilled that can help you to navigate through your life. All right? Next slide. So now, the question is, will you be able to save and invest enough to keep your promises? And what happens if you don't have enough time? Because time is none of our friend. Oftentimes we think that we have the world to live. Young people, they're very careless because they feel like, you know, death will never come to them. But we realize that death, no one knows when death is. How many of you have a piece of pen and paper today? I want you to write down your birth date on that piece of paper. Just the year. You don't have to give me the date and time and all that stuff. And this is basically for your notes. And then the next thing I want you to write is your death date. Your death date. When you're going to die. Don't know. Exactly. That is the point. We don't know what lies ahead. So a lot of times people feel that they're going to live forever, but there are two certain things in life. You're going to be born, and you're definitely going to die. If you're living, you will die eventually, unless the rapture comes. And then you're still dead because you're not here. You're not here on this earth. Next slide. So let's consider for a moment your family's standard of living. And this is how we can determine what our life insurance should be like. As you look at this chart, we have 5 levels of standards of living. The first level would be luxury. The luxury level would be where you don't have to worry about money. You can take a trip to Europe. You can buy a flat screen TV. You can buy a new car all in 1 year and still have money to burn. People that live the life of luxury, they very rarely look at their checking accounts. They very rarely have to balance a checkbook because money's constantly coming in. They don't have to worry about it. They can do like have a dream wedding or have a dream vacation, do whatever they want to do. Like we had, I believe it was Kanye West and Kim Kardashian. They went over to Florence, Rome, Italy to have a wedding. And then they went over somewhere else to have the honeymoon. Money was not an issue. But that would be a wonderful way to live. But unfortunately, it's not the reality for all of us. About 9% people in the world are in that luxury category. About 9% throughout the whole world. But then there's another level, which would be the comfort level. The comfort level is where you're comfortable. You may not be able to do the vacation and the flat screen TV in the same year, but you can have one or the other, and you're comfortable. You're satisfied with the way you're living. You're satisfied with your neighborhood, and things are working. But then there is the getting by. That's the getting by level. The getting by level is where you're at a place where you're just getting by and things are happening. You may still be able to get that flat screen TV, but you'll have to finance it for 12 months, no interest or something of that nature. And in 12 months, you can have it paid. I have come to find that people will get exactly what they want. We will make a way to do what we want to do. You may not, we'll cry broke at church, but if it comes down to something that you need or something that you want, you will find a way, come hook or crook, and make it happen. Can I get a witness? All right. So don't go to sleep on me. So then there's the next level, which is the bare necessity level. The bare necessity level is basically just getting by. You're living from paycheck to paycheck. You're robbing Peter to pay Paul. That is where a lot of people live, and that's where they're comfortable because they as long as they're working, they know that they're going to be able to make it. And then the final level would be the charity level. The charity level is where you're depending on someone else to give you something in order for you to make it. A lot of that would be my kids that's going through college. They're living in the charity level because I'm constantly giving, but they think they're on the luxury side. So a lot of us have children in that category. They're the charity, but they think they're on the luxury line. But we have to give them a reality jolt. And what keeps you on that standard of living is your ability to go to work every day, and that keeps you at the level that you're comfortable at, and also your savings. But there's always something that's pushing on those levels. The next slide. There are many different factors outside of your control that will put downward pressure on your standard of living. This diagram points to a few of them. Here we have taxes. There's nothing we can do about that. Taxes will constantly be paid, and the Bible says, render to Caesar what's Caesar. So we have to constantly pay our taxes. Inflation. I remember when gas used to be $1.25 a gallon. So that's going way back. Now gas is almost $5 a gallon. I remember when you could go to the store and we could feed our family of 5 off of $150 for the month in groceries, going to the grocery store. $150 right now would probably handle us for about a week or maybe 2 weeks, and we're not big eaters, but it's very expensive to live, and this is inflation. These are things that we have to deal with. Death is the inevitable, and that is something that happens. It's an expense that will push down on that standard of living. If something were to happen to you, you being the breadwinner, you being the one bringing money into your home, if something happened to you, what would be the standard of living for your family? Disability could be a situation. You don't have to die. There are some people that get disabled. And disability in the insurance language is living dead because you're not bringing in income. So you're living dead. Stuff has stopped, but your income has stopped, your health has stopped, so they consider you the living dead. We use that as a term. And then there are the last thing, which would be retirement. We're all looking to get to that point, and retirement could change. There are a lot of people that retire and they have to go back to work. Have you ever seen the little old ladies that work at Dunkin' Donuts, McDonald's, and things of that nature? What happens is their standard of living changes, so they have to go back to work after working years and years and years just to bridge the gap between Social Security and what they have. But New York Life, I have this blue wedge here. What that does is it helps you with your standard of living. Now, let me help you this. What would happen to your family standard of living if you were no longer around to provide the income? That's the thing we have to think about, especially if we have young children, if we have needs in our family. If you are the breadwinner, what would actually happen to your family? Would your family be able to maintain that house? Would your kids still be able to run the TVs all night long and run up the light bill and continue to eat as much as they eat? Amen, somebody. Life insurance can act as a wedge that will help you allow your family standard of living to remain intact. And no matter what happens, it would keep them at a level so that at least it would cover them for a time period. For example, if you have a young family and your children are between the ages of, say, 0 to 7, you know, for example, that they will be in your care at least until they're 18 or 20. So there are ways where you can put insurance in place so that just in case something happens to you, your family's living would not change. Yes, they're going to miss you. Yes, they're going to have some grievances, but can you imagine them missing you and not having money? There was a young man that we had that his mother died. He was about 20 years old. This just happened about 2 months ago. His mother died. She did not have life insurance. And what happened the day of the funeral, the funeral director took him to the YMCA to put him in a place to live because he had nowhere to go. And this was the same day that he buried his mother. So these things happen when we don't have things in place. And unfortunately, he had one of those trifling families that didn't want to take him in. And you can't always depend on your family, because you realize that your family sometimes can be your worst enemy, not your best friends. So, this is just the reality of life. And unfortunately, it just happens that way. And he was one of those children that was difficult to deal with. And his aunt did not want the responsibility, so they took him to the YMCA. He was 20 years old. She felt he was grown. She didn't want to be bothered. And there are people that will only, they will not tolerate you. When you wear out, they're gone. So that's why we have to put things in place so that there are some people that don't want to celebrate you. At least you have things in place that you can continue to move on and not have that great miss in your life. Now, next slide. The basic financial pyramid, and this would be a picture-perfect situation of how you could build yourself financially so you don't have to worry about things. The foundation, how many of you know the foundation is very important in any situation? If you're building a house, if you've got a car, your car is no good without wheels. Your car is no good without a motor. Your house is no good without a basement. Even if you don't go in the basement, you need that foundation to hold the house up. So basically, to hold you up financially is your insurance would be the safety net of your house. And what it would do is it protects what you earn, what you owe, what you own, and those you love. And those are the things that we need to look at. And a lot of times people feel that they don't need insurance or they can't afford insurance. First of all, we need to let you know that insurance is very affordable. It depends on the vehicle that you get in. There are different types of insurances, like the whole life versus the term, but those are things that I would go over with you on an individual basis, because insurance is just like your fingerprints. It's set for your individual needs. What you need could be tailor-made to you and your budget. So there are a lot of people that feel that I can't afford it. I just can't. You can't afford not to do it. Because what happens is there's about, say, 300-400 members at this church. If everyone at this church did not have life insurance and they started to die, it becomes the responsibility of the church. Then what happens? We'll never get the new building that we're trying to get because it'll be underground. It's a good one. It'll be underground. And our families are the worst, especially if they don't go to the church. You've been paying your tithes to that church. You've been going to that church, and they can't help you and bury you, and then it becomes a scandal on the church. So a lot of times the church does things just to save face. Not that it's our responsibility, but we do it to save face, simply because people don't put things in place. So I love Dr. McCullough for this. She's a forward thinker. Putting these types of programs in place helps us to get our houses together so that when we come in here and shout, go home, at least we know we got ourselves covered, no matter what happens. And that is the best thing that we could ever do. So in setting up your pyramid, make sure that you have the protection. Now, there are some that say, well, I have life insurance, but honestly, do you have enough life insurance? Because basically the rule of thumb for life insurance is to take your income and multiply it by 10. And if your income is multiplied by 10, that would basically be what the life insurance needs would be, by 10. That's the general rule of thumb. Because if you're married, I've met some men that did not want to get insurance because they felt like if they die, they don't want their wives to give the money to the next man. Those kind of situations come up. But ultimately, you're forcing her to get married because you left her broke. So if you give her at least an option, then she might hang out there a little longer. And remember you. But what happens is, if we don't give them options, then we sort of force them to make a way, because we are survivors. We're going to survive one way or another. So say, for example, if someone made $50,000 a year, you multiply that by 10, So ultimately, they would need at least $500,000 worth of insurance because that would at least cover their family for the next 10 years. And that's light. That's someone that doesn't have a house. That's someone that doesn't have multiple expenses. So we'll look at one as an example, and that's a slide. We're going to go down to how much life would be needed. We'll use this as an example.
Categories of a pyramid. We can't see.
Can't see this? This is, go back. This is to protect, to plan for, prior goals, and pass along. And this is what you need. So basically, there's 4 different types of planning you need to do for your pyramid. Your first would be your defensive planning. Your defense has to be intact. Then your offensive planning. In case something happens, I need to make sure that my offense is on point. Okay? Then you have your aggressive planning, which is your prior planning, which would be your, go to my chart here. Prioritizing your goals, diversifying and to reduce your risk, maximizing qualified plan contributions, overpower inflation, then the passing along of the assets, rather than having people fight over your shoes and fight over your clothes and fight over your car and things of that nature, putting things in place so that you have a plan in place. At that goal stage, aggressive planning, progressive planning, you would have a living will, you would have an accountant, you'd have all of these things put together just in case something were to happen.
Can you just say what a living will is, please?
What a living will? The living will is your last will and testaments, what your desires are in case something were to happen to you. Rather than leaving it to chance and someone saying, well, that's what she told me she was going to give me, and word of mouth, it's actually in writing what you desire. And everyone needs a will no matter what you own. Some people feel like, well, I don't have enough to have a will. You do have enough. Because someone's going to fight over your watch. They're going to fight over your ring. They're going to fight over. We had a lady in my church, she died, and we had people fighting over the lady's wigs. Her wigs. And one lady wore one of her wigs to church. It was real creepy. You know, it was just real creepy. It was like, at least some things should just be thrown away, you know, but they were fighting over her wigs, all kinds of crazy stuff. But you need a living will, because that is your last will and testament. You will really find, this is a true story. You know, we had a lady in our church, and all her jewelry, all her everything, they were fighting over this stuff. Had she had a living will, it would have never been an issue. So no matter from the poorest of us to the richest of us, we still need a will. Every one of you deserves to have a will. There are some people that don't have a will in regards to, we've had a member of our church die, and the family took the member away from the church and would not let the church family participate in the person's funeral. And that happens if you don't have a living will. Because if you have a will, you can say, I want my church, Beth Rapha, to be a part of my, my end, just in case. Because you're here more than you're with your normal family, pretty much. This is your family. And this is the extended family. And can you imagine fellowshipping with someone for years and years and years, and then their family comes in, they don't know you all, and they take you away from them? That's not fair. A lot of us don't get closure to say goodbye to the people we've shouted with and praised God with. Ultimately, because all of our family members are not saved. So they don't have the allegiance to Beth Rapha that you would have. So with your living will, you set things in order so that nothing is done that you don't know about. And unfortunately, there are people that don't want to think about the end, but the end is coming. We can see the signs of the time. Don't think about the end, but the rapture's coming. So if we don't prepare, we're not going to be ready. So either way, if we're raptured or if we go the way of the grave, we need to prepare for it. All right? And not just leave it to chance. Any other questions? Yes, sir.
Would you recommend having a lecture coincide with
Absolutely. The life insurance would be the first part because that would be the base of your financial pyramid. You definitely need that. Even if you have to start off with a little bit, a safety net. The average funeral cost in America is anywhere from $8,000 to $20,000, depending on where you're going and where you're going to be buried. Cremation is about $300. But even then, what's going to happen with your ashes? And the government will only give you $255. So there's still a short change. And you got to fight to get that. You got to prove you're dead, or your family has to prove you're dead. You know, in order to get that $255, they're not just going to cut you a check, you know, because there's scams all over the place. We know that. So I would definitely recommend thinking about life insurance, having it. And even if you have life insurance, I would recommend sitting down with a professional and at least reviewing what you have to make sure what you have is enough. For example, I have some clients that had different policies and they thought they had insurance and they borrowed against their policies, and it come to find out because they didn't pay it back, they had no insurance. So they had these policies. Yeah, I have insurance, but you forgot that you borrowed and you never put that money back. So now the interest is eating away at your policy. So now what you thought you had, you don't have. So it's, yes, I love questions.
With the life insurance policy, you know, they range from like 20, 25, you know, so on and so forth. But once you get up to 20 years, can you renew it, or should you just go out shopping for a new policy?
You're talking about a term policy.
Correct.
Term policies, with New York Life, what we do with our term policies, we have what we call term conversions, and you can convert it to permanent insurance. And there's a difference between permanent and temporary insurance. Temporary insurance serves a purpose. I wish I had a board I could show you something. But basically, show you what, just show you a little something. But basically, with a term policy, you can set the term for 5, 10, 15, 20 years, and you can renew it. But what happens with a term policy, and I'm going to show you in a few minutes, it escalates. Because at the end of the term, if you outlive your policy, you're now in a different position, age-wise and maybe health-wise. So you can renew it, but at what rate? You know, and that is the thing about it. And then once you get to a certain age, you can't even get term, because term is really a temporary fix. That's why it's cheap. And then what happens is you have to fall into categories of, for example, like a Colonial Penn or a AAA, AAA, you know, or AARP. Anybody got the AARP card? They send out rates saying you should get term insurance, but if you watch the rate sheet on the AARP, every 5 years you get a bump in premium. And then ultimately, when you hit 84, you can no longer get the live past 84. What if you become like Mother Phillips? She's about to have her birthday, 103 years old. So what happens? You know, with whole life, it covers you for your whole life. It's a permanent product. That's why it may seem expensive in the beginning, but what happens, it becomes the caviar of insurances. So I just want to show you this real quick. Can everyone see this board? You can see it?
Yes.
Okay, so here's your term, and here's your whole life. Your term will use someone my age, 21, no. No, forgive me, no. We use somebody 30 to be 21 again. Whew. But then here you go. Here's your term. They're like steps, and they go up to age 84. So say this 30-year-old may have a $100,000 policy. Now in New York, we can give you a policy for $30. For $100,000 would be the minimum. But say use a 30-year-old for $100,000. That would roughly be about maybe $25 $25 a month, roughly. I'll say $25 a month for this 30-year-old. Now, with a whole life, $100,000, 30-year-old, it goes to age 121. But what happens is when you hit age 100, you no longer have to pay your premium. That's a good thing. Here's your premium. The premium may be $50 a month. It may be more for the same $100,000. Just using this as an example, okay? So it will be till age 100 years old, $50 a month, okay? But what happens as you're paying double what you're paying here in term, you've got this thing in here called cash value. I don't write that on the board, so y'all pray for me. Okay? And in this cash value, you have money that's growing in this policy. After the third year, you start to see money growing and accumulating in the policy. Do you understand? So what's happening, this is the better buy because the premium never changes. So you can live from 30 to 100 and never have a bump in your premium. So it may seem high at first, but when you turn here, 30, say this is a 20-year policy, age 50, this $25 may now be $75. Then when you turn 70, this $75 will be $150 in terms of your premium. Well, you're still paying $50 here, the same person. So in the long run, this becomes the better buy. Because we're planning for the worst, but we're expecting the best. In other words, we're planning to live long. With long life will I satisfy thee. So this would be the better buy if you die before 50. But nobody's planning on dying. We're planning on living, you know. And so basically that's the difference between term and whole life. So this would be equated to, and now the other side of that with the term, and I don't want to get too deep into this, is what happens is when you outlive the term, if you don't renew it, you get no cash value. There's no savings here. So you have nothing to show for. It's just like when you move out of your apartment, you can't take the carpet with you, you can't take anything with you, you just enjoy the time you had it. So it's renting versus owning. At least if you cancel this policy, you have money that you can get back. There's no refunds in term. The only benefit with term is if you die. Then your beneficiary gets the money. Yes, sir.
Are there penalties if you were to cancel a policy like the one on the left that you would be in?
The whole life?
For? The term life. Like if you cancel it ahead of the term being up?
If you cancel it, there's nothing, because what happens is, say you can't pay your premium, they will lapse the policy, and there's nothing to happen. If something happens with the one on the left, the right, if you can't make your payment for a month or two, you have cash value in there, so it keeps your policy alive. You know, so things happen, we change jobs, our budgets change. At least with the whole life policy, you can keep your policy active. But with term, if you miss your payment, it's gone, and your money's gone. Can you write that for me? Because I'm not good at writing on the board. That's not my strength. Yes?
I have a question. You mentioned earlier, and I could have missed it, you talked about borrowing against your policy.
Yes.
Why would people do that? Or can you explain the process of that?
Okay. What happens is, for example, if you go to the bank and you want to borrow money, you have to fill out an application. They have to check your credit, and sometimes it takes a little while to get the money, correct? So basically, it's a yes or a no. Sometimes they say no. With the borrowing of the policy, you call New York Life. You say, you know what, I have about $3,000 in my policy. I need $2,000 because an emergency came up, or you want to go on a dream vacation, or something happens. It's your money. You don't even have to tell them why you need the money. I just want to take $2,000 out of my policy. That's a phone call. They write a check, and within 2 or 3 days, you've got that check in your hand. It's not based on your credit. It's not based on anything. It's your money. It's like your savings account. You have to pay it with interest. Depending on the type of policy you have. Like UL and whole life, those are different products. So I don't really want to get product based because those are more individual kind of questions. But yes, you do have to pay it back. And because what will happen is if you don't pay it back, it may affect your death benefit. But now if your death benefit is $1 million, it won't matter, because you may not, need to pay it back. And if you just took a little bit out, you may not have to pay that back. But it's to your benefit to pay it back, okay? But it's called a living benefit. It's something that you can actually take advantage of and be alive. The term, you have to die, unfortunately. It's for a permanent product, yes. It's not, it's like you asking your landlord, can I borrow my rent? What is he going to say? No. He start the eviction process, and then you'll be gone in 30 days, So you can't borrow. So the only thing they'll give you with the term policy, they'll give you a 30-day grace period to make that payment. And at the end of that 30 days, they want double payments because you always pay in advance. It's like anyone that has paid for child care in here. Most child care providers, they pay in advance. You pay before the services are rendered. That's what term is like. You pay before every month. You're paying in advance. Okay? So let's just go back. Any questions? All right. You all ate, so I know you're a little sleepy, so I'll sing a song for you right now. No. So here we go. Why life insurance? Life insurance is a promise. And as we talked about in the beginning, it is a promise to be there for your family, for your loved ones, in case something happens. It's a promise. That's all it is. And for people that donate to their church, their tithers and their givers to their church, if you name your church as a beneficiary or partial beneficiary of your policy, you're leaving a legacy for your church. And that's basically what we need to do. We need to realize there was a survey taken, and this poll was taken about 5 years ago, and the numbers are up slightly, but not that much, not that drastically. Over 90% of people of color do not have life insurance. 90% do not have life insurance. 90% of people do not have coverage. That was a fluke. But now, think about this. Remember when Katrina hit in New Orleans? The New York Life agents went down to New Orleans to help those families that were devastated by Katrina. In the white communities, we went to Katrina. We went to the neighborhoods, and we were giving out checks to the people that had policies. We went to all the black communities, and we were giving out food, clothes, and blankets, simply because they didn't have life insurance. So there were people that had to move from New Orleans, could not rebuild their lives, could not rebuild their homes, could not do anything because they had nothing as a safety net. And it's urgent to really think about how critical this is. How, it's not just, it's not a purchase, it's a selfless purchase because I'm thinking ahead. Because ultimately, if you take a picture of your family, and I love family portraits, think of your family portrait, take you out of the picture. What would happen to those people in that picture without you being there? That's a sobering thought. What would happen to my prayer when my kids were little was, Lord, let me live to see my kids get grown. And God has been faithful. God has really been faithful. But that was my main concern. What if something happens to my daughters? I've got 3 daughters. And I would not want my daughters to have to go in a system. Anything could happen if they're not protected. Rapists, molesters, all kinds of stuff. If I'm not around, I can't protect them. But at least if I got some money or a safety net there, I can put in my will, this is what I want to happen to my daughters. God forbid something happens to them. Thank God they're grown. God has been faithful. So now I'm in another phase of life. Now I'm saying, Lord, help me to pray. Help me to see my grandchildren get grown, Lord. See, that's why you get married early, so you can at least see generations. I got married at 18, so I begin to, I've grown up with my kids. I've grown up. So, me and my wife, we thought having our kids early that we would be able to travel and enjoy life and yada, yada, yada. Didn't happen. If you ever want to make God laugh, make a plan. Make a plan, and God will laugh right at you. And that's what has happened. So, any other questions? So I think you all have the gist of what I'm talking about. And so it's really, really important that we have a one-on-one, that we set up a meeting, and that we come together, and that we actually meet and drive this thing, this idea of not covering our family out. Let's make sure that everyone in this church is covered. Yes, she has a question.
So let's say, does your company afford policies that are obtainable to, let's say, someone my age, like a college student? That
Yes.
could be.
Young people are very easy. It's easier to get insurance on a young person, especially minors. They don't have to go through the underwriting that we older ones have to go through. Because when they're young, like say from the age of 0 to 17, there's no, even with obesity and different things that's in America, with our young people, they don't have to worry about diabetes, heart disease, and all that kind of stuff. So usually it goes through underwriting with a snap. Within 3 days, you can get a child's policy. But what happens is with children's policies, it has to be whole life, which is very affordable. For example, I took out an insurance policy on my grandson. He was a year old at the time I took it out, and I took out a $50,000 policy on him, and it was like $25 a month. And the 20 of whole life. And the $25 will accumulate cash in his policy. So by the time he's ready for college, I now have a gift that I can give to my grandson. And as the policy owner, you control the money because you are the policy owner. So say, for example, you have a grandson or you have a daughter that winds up being a knucklehead. Because you are the policy owner, you don't have to give them that money. You could say, you know what, I'm going on a vacation because you're a knucklehead. And you take the money out and go on vacation and give them the policy. So you control the shots in that situation. When you opened it up with well intentions. This is going to be for them or that. We do a lot of grandparent gifting, where the grandparents gift, rather than buying them another iPod or buying them another pair of sneakers or something like that. You give them a gift that will last a lifetime. And when they're young, that is a definite time to get it. And for college students, I have a young lady, she's 22 years old. She took out a policy, $100,000, and it's only costing her $25 a month. So it depends on your health. You have Select Preferred, which is the highest rating you can get, But then most of our quotes go non-smoker because that's like borderline. But then if they take blood and urine and all that kind of stuff, and I don't want to get gross about it, and they find out that you're healthy, then they'll change your status, and then your premium goes down. But basically, we quote high so that you know what the expectation is. But if you test better, then you know that your budget is going to be met because the premium comes down. Yes, sir. What's your name?
If we're in term if we're in term or whole life for that matter.
Yes.
But we want to go back and forth, but we haven't. The policy hasn't reached maturity, but we're like in the middle. Can we switch?
Yes. If you're in a term policy, we have what we call term conversion. If you switch within the first year, New York Life will refund your first year's premium and apply it to your whole life policy. What also will happen is, say, for example, you take out $1 million policy. You can switch some or all of it if you desire. You can say, you know what, I only want $100,000. You can take $100,000 of that term policy and apply it to whole life and still have $900 left in a term policy and have $100 in whole, if you understand what I mean. So you can cut it up. But what normally happens is you keep the term for a period of time depending on what your needs are. Most people get term, like say for example, you just buy a house and you got a 30-year mortgage on it. So what you do is you take out a 20-year term, and then if something happens to you within that 20 years, your house is paid for. You know, so it serves a purpose. While your kids are young, in case something happens to you, you want to make sure they can go to college and things of that nature, which I want to go to the spending, and then that way we'll end on that note. This is just an example of the insurance needs. How much life insurance do you need? You see that slide? Here's an example of a 35-year-old dad with a new family. He wants to make sure there's enough money to cover his funeral expenses. Next slide. Yeah, there you go. So basically, this is how you spend the money, spend down the money. The funeral is $20,000. College education for his child is $400,000. There's an outstanding mortgage of $400,000. And the other debts, which will be the car loan, credit cards, and contrary to popular belief, some people feel like when they die that their bills are gone, they magically disappear. That doesn't happen if you have loved ones, especially if you have a wife, if you have a husband. Those now become your bills because you're legally bound together. Unless you can prove, you know, that's not me, I didn't sign on it, whatever. You know, then you're just going to spend money in legal fees. But basically, 15 years of salary is $750,000. So he needs, upon his death, $1.6 million. He has $150,000 in savings. That's earmarked for what if. But then his life insurance need is $1.4 million. And that's just an example. I have a brochure on the back that you stapled. Can you get that one for me? No, not that. What I gave you out today is called a personal financial checkup questionnaire. This is something you should fill out at your leisure and just decide, you know, see, are all your needs met? Yeah, I just need that. And you can give this out. Yeah, just give me one though. Basically, this is an example of what it would cost to have anywhere from $100,000 to $1 million worth of coverage. $1 million on a 30-year-old would be $39 a month. That's next to nothing. I'm sorry? No, this is term. This is convertible term. Term is always the cheapest way because what term does, it at least gets your feet wet. It gets you in the door. And that's, as I said before, term serves a purpose. So you would utilize term if you have a temporary need and you want to make sure something's covered because you don't want any holes in your financial foundation. For a female, say 30 years old, $1 million is $34 a month. Why is it cheaper for a female than a man? Does anybody know? That's a good answer, but no. Women live longer than men through mortality rates. You know, and basically how they come up with these rates is through mortality rates. They think that women will live longer. And people with pets actually live longer than people that don't have pets. So it's very interesting to know that. And they have all different statistics. So if you're single and you don't have a pet, I advise you get a pet now. So you can live longer. So. A 50-year-old male for $1 million is $132 a month. You know, and this is a 10-year convertible term. And these are just basic rates. These are people that are in top-notch shape. But like, let's look at, a 30-year-old male for $100,000, that's only $10.10 a month. So tell me you can't afford it. It's affordable. You know, what's happening is there are people that will put insurance on their cell phones, but they won't put insurance on themselves. So we've got to be very careful that we make sure we insure ourselves. You are your most valuable asset. You're saying when you insure your phone and not yourself that your phone is worth more than you. And that's what's happening. It's the mentality. We've got to rethink what's the most valuable asset you have. It's yourself. You know, so it's something to think about, and I would love to have each and every one of you as a client. I'd love to sit down with you, even if you have life insurance. Maybe we could review, see what you have. And it's free. You don't have to pay for my services. It's just nice to have a conversation and just see where you are to make sure everything is on point. And that's what we do as preachers. That's what we do as agents. We just make sure everyone is in place. Some will take, some won't. But the ones that have it, you basically can know when you go to the funeral. You ever been to the funerals and saw those gray cardboard boxes and stuff like that that don't wind up? That's somebody without insurance. Never seen them? Oh, thank God. Well, I've seen them. I've seen them, and they come with a little latch. They don't even lock. You know, you put a latch on. So we just got to make sure we put everything in place, you know, to make it a little lighthearted. But they do have them, you know. So we want to make sure that everything is in place. You have my information. I need you to fill those cards out. Did you all do your homework while I was talking? So I need the cards. And I'll take a few more questions if there's questions. Miranda? Yes. Yes, I'm licensed in Jersey. I'm licensed in New York. I'm getting my license in Connecticut. So wherever you want to be, I'll get my license. Now make sure you make your thing legible so I can call you and not have to guess at the numbers. Can I call you? You gonna hang up on me? No. Yeah.
I thought it was a lot more money.
Yeah, no. It's very affordable.
What about the mortgage, the insurance for the mortgage? It's not called mortgage benefits insurance. If something happens to you, they'll pay off your mortgage?
Yes. Well, the
Repeat the question so that they can hear it. That was an excellent question about the mortgage, yeah.
Mortgage benefits insurance is what you have when something happens to you, it pays off your mortgage.
that's a term policy.
Okay.
They call it, they give it a different name, but it's basically a term policy. So say, for example, you buy a house and you want to take mortgage insurance to make sure your mortgage is paid off, you're still going to have to go through the medical to make sure that you're healthy enough to get that term policy. It's still a term policy. At the end of the day, it's a term policy. Because insurance companies are not in the business of giving away money. They want to minimize their risk. And how they minimize their risk is make sure that who they're insuring is at least insurable. You know, so you can, yes.
As a single parent, I was just trying to understand, should I insure myself or should I just insure the entire family? What would be like the best scenario?
I would say all of them.
All of them.
And the reason I say that is because what you do for your children by getting them insurance, you take away the headache of once they become older, having to go through underwriting, and also you help them to develop a cash value, which you can actually use and tap into as a savings. For example, I have some clients, and a lot of this is privileged information, so we give no names and stuff like that, or I'll lose my license, and I'm not willing to do that. But I have a client particularly that is not insurable. So what they did is they took out an insurance policy on their child. And what happened is the cash value that's growing in that policy, she's going to utilize that as her death benefit. But when she dies, what happens is the child still has a policy in place. You know, so that, and she did a custom product, meaning that I'm giving myself 10 years to pay it off. So that when my child, in 10 years, I don't ever have to pay life insurance again. You can customize it, that it doesn't have to be until age 100. You can customize it for 5, 10, 15, 20, however many years you want on life insurance. Yes. Good question. That's a really good question. But what it does is for our children, it gives them a sense of security. Hassan is going to talk about 529s and college planning and stuff like that. But whole life helps to defray some of that cost as well. You know, when you have a whole life policy on a child, especially young children, it gives it time to accumulate so that they'll have some money that they can have tucked away for when it's time for college. Yes? Oh. Yes, sir.
Can you have multiple life insurance?
Yes. You can have
Up
more
to
than
how
one.
many?
You can have as much as you can afford. You know,
Okay.
like for example, we have one client that he had a policy for his wife and he had a policy for his girlfriend. Of course, he didn't go to Beth Rafa, you know. But you can have as much as you want, you know. And the girlfriend, actually, her policy was more than the wife's policy. But, you know, you can do what you want. Yes.
Does she know that? Because sometimes, you know, you might be planning to take her out or something.
Take who out?
His girlfriend.
No, it was on him.
Oh,
He had life insurance on himself.
Oh,
And
I
he
see.
named, in one of his policies, he named his girlfriend, and in one, he named his wife.
I thought
and-
he took policies out on them.
No, no, no. The one he had on his girl, the one where his girlfriend was going to receive, it was much higher than what the wife was getting. And it's legal because it's your policy. You're the policy owner. As I said before, the policy holder has rights. You can do whatever you want to do with your policy. For example, you all heard of Leona Helmsley, right? She willed $10 million to her dog. No one could stop her. That was her money. You do what you want to do. It's your money. Any other questions? Well, no questions. I just want to say thank you so much for having me, and I hope this was informative to you. Thank you.
Just get some help helping Pastor Page. Thank you again. Let's give him a real hand clap of thanks for helping us to understand the difference between everything. And it's nothing like it coming from a pastor, right? I mean, nothing like it coming from a pastor. I think you've probably